Hey, good morning, everyone, and thank you for joining, and really thank you for having me. Um, John gave a little bit of my background. I've been with Barrington Research since 2001. We are a very small boutique brokerage firm in Chicago, Illinois. We have about 30 employees, so we are a very small player in the market. We have 8 analysts. We specialize in various areas of business services. And even with the small company like we have, we've been pretty good at getting companies to cover on a research basis, as well as being able to drive a lot of corporate finance business, which is important. We've been on the cover of deals with Goldman Sachs, for instance. So if you ask anybody in the investment community, I think they'll say that they have a high degree of respect for what we do. So I've been doing this for almost 40 years. I don't want to age myself, but my first year in the market was at 750. So that'll give you some idea of how long I've been doing this. So what I have done is I put together about 10 or 11 bullet points of things that I've experienced from the IR side, from covering companies on the sell side. And it's really how I think the process can be improved over time. John, however you want to start from there, we can take it in any direction that you guys want.
Yeah, so thank you, Gary. Let me go through the format. What Gary mentioned, the comments and the thoughts that he's put together, which hopefully will be helpful for everyone here in their careers, you're going to get after the meeting. I did that deliberately so you're not reading during the meeting, so you can focus and ask questions. Gary and I really want to do this more as a fireside chat versus just pontificating. So our format is going to be to go through best and worst practices relative to the following areas. And I guess the caveat, Gary covers micro caps, small caps, some mid caps. My former company was a mid cap. So if you're, Walmart or some huge company like that, huge large cap, his comments may or may not be applicable. Some I think are definitely are. So what we're going to talk about today is earnings, delivering bad news / bearing the bad news, always fun, guidance, everyone's favorite, access to management and road shows, particularly in the age of COVID, arguing valuation with analysts, never a good idea, but your CFO or CEO may still do that, and time permitting IR websites. And so for each topic, I'm going to make sure Gary kind of circles around the 3 T's, what I call the 3 T's of investor relations: timeliness, transparency, and trust. We'll take questions through the chat function. We'll get through as much of this as we can. So let's jump in. So let's start with earnings as year end. For those of you who are at a company, it's most likely a December year end, so it's very timely. So Gary, can you tell us about best and worst practices here? And without mentioning specific companies, please, let's start with timing of the earnings release, timing of the conference call. How do you schedule it? What works, what doesn't work?
Sure. Okay. And again, as John mentioned, I'm in the micro, small, and mid cap range. So a lot of what I'm saying may not be totally applicable to bigger cap names. But as far as the timing of the earnings release, one of the bigger issues that we're starting to have with companies reporting is everybody wants to report the 5th or 6th week after the close of a quarter. And they also want to report on either Wednesday or Thursday, particularly on a Thursday. And then they all want to report after the close. So there's been times where I've had 6 or 7 companies reporting in one day. Very, very difficult to work through all of that. Management is not happy when they've devoted time to speak to the analysts after the call to discuss the quarter, and you've got to tell them, I can't get on your call because I've got all these other ones stacked out. So one of the things that as a bullet point I put down, and glad John mentioned it, is that if there was a way to maybe move away from that Wednesday, Thursday format of reporting and look at things like a Tuesday, look at things like a Monday. I mean, it used to be that you never reported on Mondays or Fridays, but I think that taboo has gone away. So that's what I, that's what I have to say on that question, John.
Okay, good. So going to calls,
Mhm.
do you have any companies that are Zooming their calls, or are they still audio? I read an article that said even like the big tech companies, they don't want to see how the sausage is made. I think Netflix might do a Zoom earnings call, but it seems, what's your experience there, Gary?
Everybody's doing audio, nobody's doing Zoom. And one of the things that I found with a couple of my companies is that they actually record the call the day before, play the call for about the half hour at the start of the call, and then they'll be there to take questions. So I have not experienced any kind of movement to doing Zoom with the companies that I cover. And I don't think any of the other analysts in our shop have it either.
So really not of interest to the buy side, you think, or the sell side?
I probably think it would be of interest to the buy and sell side community. I'm not sure the companies would want to do it, to be brutally honest with you. So.
Okay. All right. So let's move to earnings slides. How important are these to you? And do you see, this is kind of a leading question, do you see companies, changing what they're disclosing depending on if it's a good quarter or a bad quarter with their slides? So two-part question.
The answer is to the second part of the question is very, very rarely does that happen. I think that, throughout my career of doing this, I think I've seen that happen 5 or 6 times, and you immediately get caught on it. That's a losing proposition from the IR standpoint, and it's a losing proposition if your CEO insists on doing something like that. You need to maintain consistency in what you're doing, and a focus on doing it correctly. As far as slides for any conference call, I think they're great, especially if you have a company that has a lot of metrics that they talk about in the narrative. To be able to put that, if you're not going to put it in your press release, to be able to put it on the slides is just great to have hard copy of all that. So I'm a big proponent of using slides, and some of my better companies do a really great job with having slides that go through all of the pertinent points that they want to talk about in their conference call. So I think that's important.
Okay. Do you see, just a kind of a follow-up, do you see them reading the slides, hitting the high points, or is it a combination of both?
Hitting the high points of each slide, not reading through it.
Right, hopefully not. Okay. What about non-GAAP measures? Think about the companies you follow. Are you okay with what you're seeing relative to how your companies are using non-GAAP measures, or are they kind of getting a little too creative?
The majority of the companies that I follow are using non-GAAP measures, and as long as they're consistent in the metrics that they're using within the measures, I don't have a problem with that. I tend to look at companies more from a private market value basis, so I'm always looking at adjusted EBITDA, so whatever goes into that calculation of adjusted EBITDA, just maintain the consistency. I mean, sometimes in some cases I've had companies put in like $5 million of one-time rebranding. Well, that to me probably is something that shouldn't really be in there. But because it is a business expense, it is something you needed to do to position the company for growth in the future, and it shouldn't be highlighted out. I mean, you could talk about it and say, yeah, we had $5 million of incremental expenses that we didn't back out. I think that's always a good way to do it. But again, the companies that I do, they've been pretty consistent with how they report, and even if they're using, adjusted metrics.
Okay, good, thank you. So Gary, you and I, in preparing for this, we talked about one of your favorite topics, which is the old earnings miss and pre-announcing versus not pre-announcing.
Right.
Can you wax eloquent there?
Yeah, I could wax eloquently and very simply here. If you're going to miss your numbers on a quarter, do not miss your numbers and report them on the day that you are going to report earnings. Report them before that date. For some strange reason, the market will tend to forgive you more so if you miss a quarter and you pre-announce it versus reporting on the day of and missing the number totally. That's just verboten, taboo, and whatever. And, John, we were talking about this yesterday. One of the reasons why that is so important, and I'll give you a prime example. We're actually going through this right now. A lot of these smaller companies that we have are falling out of bed in terms of their stock price. And I've been encouraging them to pre-announce, and I just had one do it today that blew away the Q4 numbers, and the stock's up about 15, 16%. So that hopefully will stop the price slide. The other thing that can happen here, and it happens quite often, is say we're 2 weeks from your earnings release date and the stock is going down, 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 down. I'm getting calls. You guys on your end can't really talk to anybody because you're in the quiet period, and they're calling me and saying, are you hearing anything? You hearing anything? And I'll say, no. I said, but I do know one thing about this company, that historically, if they're going to miss the numbers, they're going to report before their earnings date. And so far, we haven't heard anything. So I just think it's a market function versus anything fundamentally wrong with the company. So that's one of the best examples I could give.
So let me ask you this, think about your companies, and I'm sure virtually every company eventually misses earnings, I think. But what percentage would you say are proactive and will pre-announce versus, laying the turd on the table of the day?
Probably about 20%.
All right.
It's again, I'm not on your end on the IR side. Is it your CEO that doesn't want to do this? Is it the general counsel that's saying we can't do it? I don't know what goes into it. All I can tell you is just based on my experience is that it's better to pre-announce something than it is to do it on the day of. So.
Yeah, I totally, from my years of experience, it's a hard battle for an IRO to fight. You have the GC, there's probably outside legal, there could be board. It's tough.
Yeah, it is.
We're gonna, before we move to guidance, does anybody have any questions they want to throw in the chat box? Or, since we're not getting slammed with questions, I would say you could take yourself off of mute and ask them, but I just want to see if there's anything on earnings before we move forward to guidance. Going once, going twice. All right, let's go to guidance. So Gary, best and worst practices here.
I think that the best way to present guidance, if you're going to present guidance, is what we call UPOD, under promise, over deliver. And I think it's always better to use a range, so give yourself some wiggle room. But if you think your numbers are going to be $1 to $1.10, start the year at 90 to 95, and initially, the lessers of your stock will blow out of it because they're saying, oh, there's something wrong. But if you maintain this kind of consistency and people know that you're lowballing and you have a history of taking it up, I think that's the best way to play earnings. To be very honest with you, I think some of my companies that do not give earnings at all, but just say our target is to consistently grow our top line between 5 to 10%, and our adjusted EBITDA, say between 8 to 12%, like Ritchie Brothers, for instance, which I don't know if you guys are altogether familiar with that, but it's a big auctioneer of equipment. They do not give guidance, and the stock has done phenomenally well, because the one thing that happens there, I think, is You don't get the short-term or hedge funds trading off this, that, and the other thing based on a quarter. You get real investors that want to hold the stock, that understand the business, and want to grow with you as you try and enhance shareholder value.
Okay. So a couple of questions in the chat box. One goes back to earnings. The question is, Bill asks, pros and cons of morning calls versus afternoon calls. And I'm assuming he's referring to either pre-market or post-market, but do you have a preference, Gary?
I would prefer to have the calls in the morning, just so I have the whole day to work on what I need to do, as well as answer questions. But again, it's got to be on the schedules of your C-suite people. I understand that. So I guess that's kind of an answer. I'm kind of tiptoeing around it, but
Yeah, one thing we didn't talk about, Gary and I talked about this in our planning, is that it makes sense if you can, particularly if you're a smaller peer in the group, to identify when your peers are going to be reporting. So when Gary comes to that Thursday, he's not going to tune in to, say, the Car Global call, because there's a bigger company he has to tune into.
Mm-hmm. Mm-hmm. Yeah. And then we have another one. What is an acceptable range for guidance? I think a band of 10% either way, in terms of 5 to 10%. From where you think you're going to be, and as I said earlier, I would always be a proponent of starting the year under promising and setting the bogey that you can over deliver, because when all is said and done, that's what the market and that's what investors really like. Consistency in that regard.
Right. There's a question here I'll take. Are there SEC? I'll go on. Are there SEC/NYSE NASDAQ rules around the need to pre-announce? So there are not that I'm aware of, but you really put yourself in a box depending upon how big the miss is. If the consensus is $1 and you're going to miss by 5 or 10 cents, okay. But if you're going to miss by 25, 30 cents, I mean, any conversation, you're on such a slippery slope, particularly if you know it early before you go in your quiet period. It just can be very, very ugly. But the point question, the specific answer is no, there are not specific rules.
Okay.
Going back to guidance, Gary, quarterly versus annual, do you need quarterly? Is annual good enough? I mean, what are your thoughts here?
Annual is fine. I would not be a proponent of doing quarterly, because again, then you get the fast money being able to play your stock on a quarterly basis, and it just creates a lot more volatility.
Yeah, no, I agree. So from the companies you look at, do you see more and more companies moving just to annual guidance and moving away from quarterly guidance? Is there a trend here?
Most of them are doing annual guidance. So there's very few that do quarterly. I had one company that was doing quarterly, but they had a business model where they had 95% recurring revenues, so they had the ability to do that. It was a pretty easy call.
Okay. And what about, do you see any companies give what I'll call a multi-year roadmap of where they can get? I know you tuned into Car Global's virtual analyst day, and they did put out some long-term bogeys, I think out to 2025. Do you see other companies doing that, and is that helpful for you in writing research?
It is helpful in writing research. It is helpful in selling the stock to investors. And I would say more and more companies are starting to do that.
Okay. And then one more question on guidance before we go to access to management. How often do you see a company beat earnings and then not raise guidance? And how do you think, how does the buy side perceive that when that happens?
Usually that happens either with the first or second quarter report, more so with the first quarter report because we're early in the year. And again, the lessors, the entities that are leasing your stock are going to add to the price volatility there. The investors know what you're doing. So I would say that's more of an early year phenomenon, and that by the time you're through Q2, I think that doesn't become an issue anymore.
Got it. Got it. All right. If
I
there are
think
no more,
there is a question here from someone. Our GC has indicated pre-release only of a miss is signaling. I'm not.
I don't know that that's a question. I think they're making I think if I'm interpreting Mike's comment is he's saying a pre-release only if, yeah, I'm not sure. Yeah, I mean, you're going to pre-release. I mean, it seems like a good practice. If you're going to pre-release a miss, it's signaling. Yeah, you're going to miss earnings.
Right.
Yeah. So
Mike, do you want to, expand on that?
Yeah.
Well, if you do, we can get to it.
Mike, you
Yes.
can unmute and let's see where he is.
Yeah, sure. Good morning. It's Mike. Hey, yeah, our GC says, well, and then you have to pre-release both good news and bad news, because if the market doesn't see a pre-release, they then conclude that you must have met or exceeded your number. So if you have a practice of only pre-releasing the bad news and they see nothing, they interpret that as the numbers have met guidance or exceeded. That's the point.
Yeah, I hear what you're saying. You're talking about setting a precedent, and it's part of the slope that we as IROs are on. But I certainly understand your GC, and the GC, the IRO is normally the most conservative person in the room, second only to the GC and maybe the controller. Moving on to access to management. Gary, I know this is pretty critical for you. It's an important component of how you get paid. Can you speak to it now in the age of COVID? It's a different animal, I'm assuming.
Yeah, it is a different animal. From my standpoint as an analyst, and I've done a lot of virtual NDRs, and we actually started doing in-person NDRs in cities that had opened up prior to the variant starting to spread again. Let me just say, from my standpoint, there's nothing better than spending, having dinner with management and maybe some accounts the night before, and then going on 4 or 5 different meetings the day. It's all in person. That's just great. You get to learn. You get to really learn more about the company, pick up things, get to know the management team, their values and all that. That's important, but obviously we've got a situation now where it's hard to do that. So what we've flipped to now, and I think it's going to really change it's going to continue to be a trend going forward, is doing Zoom calls. And we find that the management teams want to have that accessibility to the investment community. And it's a lot easier for them, given their schedules, to take a day and do Zoom calls rather than have to get on a plane and fly somewhere and fly back. So in one sense, we haven't had as much face-to-face physical, but we've had more face-to-face via Zoom because it's easier to schedule. And I think that trend is really going to continue, to be very honest with you.
Yeah, no,
I would be interested in hearing what some of the IR people are thinking on that topic as well.
So why don't we take a pause? That's a great thing. And does anyone, you can unmute and you want to chime in on your experience? Does anybody have anything they'd like to comment on?
Zoom call Reg FD. I would assume that that has something to do with full disclosure, is that?
Yeah, so, you're not giving, material information that hasn't been released to the broader public. And I would say whether it's a Zoom call or you're doing a physical NDR, I don't think there's special rules for Zoom versus a physical NDR. I think hopefully, I'm assuming that everybody on this call understands how to keep their senior leadership Reg FD compliant. It's easy for the IROs. It's tougher, I think, as you move up the food chain. But yeah. There's another question. Any discernible differences in the IR practices of domestic versus non-US companies? Gary, I don't know if you have any experience there. I do not.
Well, I have a couple of Canadian companies that are domiciled in Canada, one in Toronto and one in Vancouver, and it's basically the same with the IR practices. There's nothing different there. So.
Right. So in terms of access to management, are there any further questions here? If not, I'm going to go to our next topic, which is valuation discussions. And I think IROs, I'm going to make a generalization, are pretty good here. They know it's not their job to teach, the sell side how they should be valuing their company. But I'm guessing, Gary, that the CFOs you deal with and the CEOs, if they're looking at their peer and their peer has a greater valuation, that they're going to chime in and maybe try to convince you, Gary, to increase your multiple. Do you see this happening?
Rarely. I mean, and actually, usually I'm the one that'll bring that up to their attention and say, okay, what can be done better here to lower this multiple discount that you're selling at versus your peers. What I often will say to a CFO or a CEO when they're frustrated because their valuation isn't what it should be is, well, if I was running the company, I would be engaging an investment banker and I would have a book out there and I would try and sell the company, because there's some kind of disconnect between what you guys are doing and how the market is valuing you. And I understand it's frustrating to the C-suite people, but there's just sometimes where that issue crops up, and there's just nothing you can do about it except to bring in some kind of an exogenous action that raises the stock price. I mean, I'll give you an example if you don't mind. I mean, it's a company that was bought out a couple of years ago. It was a company called DealerTrack that basically what they did was they had a network of dealerships where they would connect the dealerships to banks to do lending. So like when you go in to buy a car, when you're in the F&I office, the F&I guy is putting your details into a computer, and that's going through DealerTrack's network. And they had made a number of acquisitions and done really well. They made a last acquisition, was a fairly big company, a company called Dealer.com that did websites, et cetera. And the stock wasn't performing as it had in the past. I kiddingly was at a Cubs game with the CFO, and I said, well, you know what, maybe you should just sell the company because the market's not recognizing this. And 6 months later, they did. So.
Wow. Okay. So you can't go by nobody listens to you, Gary.
Well, but I'm just saying, anecdotally, you're asking, I know there's a whole level of frustration. I mean, there's a level of frustration on the analytical side too, when the C-suite people are hammering us because of our ratings or whatever. I mean, it's a very, very sensitive issue. In my humble opinion, and I've told this to my director of research, I would get rid of all ratings. I would not have a rating on it. I would have a price target, and I would have a comparable trading analysis methodology that would show this is what my price target is. And without having a rating on it, the buy side's going to make up their own mind anyway as to what they're going to do. But I would get rid of ratings totally.
Is that because you think the C-suite is too hyper-focused on, oh, we had a buy and now we're a hold, so I don't like Gary? Or what's the rationale, Gary?
That's the rationale.
Okay.
People get, the C-suite guys get ticked off when you do that. And
Yep.
it's nothing personal. I mean, excuse me, fortunately, we're not one of the companies that where we have to have 33% of our stocks are buys, the rest are holds or underperform. But it does get to the point where, you know, like I had a stock that went from 1.5 to 8.5, and I you know, it hit my price target, and I said it was a market perform, and you know, I got a lot of flack on the other end, and you just got to hold your ground. But now it's back down to 3.5. So I'm only telling you all the good things I do. There's also mistakes.
Yeah, well, we all have them. I want to go back to access to management. We didn't talk about this, and I think it's pretty important with the chip shortage. You know, I'm an auto guy, and supply chain issues. Do you see, or how often do you see companies that maybe are in the penalty box, so to speak, from a valuation perspective, and you say, hey, John, we need to get management and go on the road? And I tell you, Gary, you know, they're waiting for auto production to come back. They're waiting for whatever. How prevalent is that today, Gary?
Well, it's happening right now, particularly with a lot of things that I deal with on the auto side. So, but what I can say is that the majority of the companies, when I suggest that we need to get out on the road, they understand why, and they'll try and accommodate. So, you know, especially now in this kind of situation, I mean, I want to get most of my auto-related companies out there because I think this chip shortage is eventually going to end. You know, we're starting to see inventories creep back up at dealerships. And these, you know, I've had stocks that have been cut 50-60% because of this, and it's no fault of theirs. That you just can't execute in a market where you can't get in, you know, the inputs to produce the cars.
Yeah, no, that's an excellent point. I would think, particularly if you're targeting long-term investors, you know, Fidelity comes to mind, you know, market the stock when it's cheap versus when it's pricing. All right, there's a question in the chat box. How do you protect yourself from getting tangled up in potential insider trading material, non-public info situations? And I guess this is directed to you, Gary. If, you know, in the course of a meeting, I'm sure it's happened in your career, you find something, you find that someone, a CFO or a CEO, I don't think it's going to be the IRO, shares something that shouldn't have been shared.
Yeah, it has happened in the past, and what, you know, what the way it gets handled is, please don't put it in writing. I mean, like, you know, and to an extent, it's like, please don't repeat this. But a lot of times, it's more or less, please don't put this in writing. So, but you know, in material non-public info, it's not so much specific info. It's just, I would say, situational info in terms of you know, fundamental trends, things like that, or maybe some relationship with a potential supplier or a customer and all that, that, you know, the company would rather not see in print. I think by and large, John, and probably with the majority of our people, you know what your job is, you know what you have to do, you know what you can and cannot say. And everybody's got to abide by the rules. And if you're in a situation where they don't, then, you know, you've got to make a decision as to, you know, where you go from there.
Yeah, no, well said. So our last topic is IR website. So how important are the resources that IROs put on their websites? How important do you think they are to the sell side, and maybe how important do you think they are to the buy side?
I think it's very important. I mean, it's, like to definitely have all of the earnings releases and any presentations up on the website so we can access them. I also think that having the ability to access the financial documents like 10Ks, 10Qs through the company without having to default to the government website for documents is pretty important, because that government website can be cumbersome. So I like to get the documents printed in or saved in Word, so I can annotate them and things like that. But yeah, I think the website thing, like, that's the first thing you visit. It's like buying a house. You're going to do a virtual tour, right?
Right. Now, there's a number of vendors out there, and some companies have done it. I think we did it at CAR. We're supposed to just getting PDF or another document. You can actually download the numbers in Excel so you can bring it into your model. How important is that to you, Gary?
I have never done that. So okay. I've never done that. I'm just happy to get a hard copy of the numbers and I put it into my model itself. So I can't really comment on it.
Gotcha. Okay. So we went through this in amazing time. Are there other questions or other topics that y'all have for Gary? We've got a captive sell side analyst, so now is the time to speak up. Or maybe we covered everything and nobody has anything.
Maybe I could go through some of my bullet points real quickly.
Yeah, please go ahead, Gary.
Actually, I do have 10. Some of these things we've already talked about, and we call it, wait a minute, we do have a question here. How often do companies get a formal business valuation done as a part of their structured exit plan? Put differently, under what circumstances do you see they need for an independent business valuation? I guess the way I could answer that is every company has an investment banker that they're dealing with, and every investment banker is always knocking on the door with some kind of a proposal, be it a acquisition or bringing up to the management team that their stock is undervalued and that it might be a good idea to think about a take private transaction if you're not getting rewarded for what you're doing in the market. So I would say that is an ongoing and constant process, just because bankers being bankers are always going to try and sell something. Hopefully that answers the question.
Yeah,
okay.
No, I agree, and because you're a part of this. So back my old company Odessa in 2007, our stock was just going nowhere, and while we did our own valuations, we had to engage in a independent investment banker. The board has to protect themselves, and
right.
The valuation models that we went to market with were really from the banker. They weren't from our FP&A area. So
okay. All right, so I highlighted this as sell side analyst pet peeves. I think that was the topic here. I should have probably said ways to make the process possibly better rather than starting off with a negative connotation. We already talked about missing the quarterly numbers, on lowering the guidance on the day of earnings. It's always better to pre-announce the results, especially if they're going to be bad. The second bullet point is correcting estimate outliers. I think you have to be cognizant of what the individual analysts' estimates are, and you need to get them in line if they're too high or too low, because it's going to skew the consensus. And especially I had situations where I'm actually working on something now. It's a smaller company. It was followed by one of the major firms in New York. And because it's come down so much in price, the analyst has not updated his estimates for about a year. So they're out there and they were in fact set, and we managed to get them out of there. So that's just something to keep in mind. We talked about timings of earnings release and conference calls. I would say in terms of most of them are done Wednesday, Thursday, 5 p.m. Eastern time, start times. Consider alternative times and days, Monday, Tuesday, and Friday. Here's one that I think is, I would like to know why this can't be done more often. I'll have some calls at 8 a.m. Eastern time, which are 7 a.m. Central time. And it would be great if we could get the numbers after the close the day before. So we would have some time to take a look at them rather than having to get up at the, 4:30 in the morning. Pre-COVID, you have to get up, go into the office, take the train in because I live in Chicago. We don't drive. With the pandemic and working from home, it made it a little bit easier. But again, if there was a way that those numbers could be released the night before, and John's old company did that really great, so you'd have some time to look at those numbers. That's nice. Transparency.
Time in might be of help. So what we would do is we would put out, we'd call it a supplement, which is basically the MD&A from your 10Q or 10K. Obviously, depending upon what comes up on the earnings call, you might have to adjust it and then file your Q or K. But we also wanted to give folks like Gary, all that detail insight that they're not going to get on the call. We're not going to read it to them on the call, but yeah.
Okay, we just have, there was a response to what I was saying is that in terms of getting the numbers out, is that simple answer is that the presentation slides are being reviewed through the night. Again, okay, I would have thought that this would have all been buttoned up, prior, but again, I'm not, in the C-suite corporate world, so I'm just giving you my thoughts on what I would like to see, but that's something that I never considered. So thank you for bringing that up. Another question, what is important to see in an annual report? Glossy intro section?
So that's the section, I think of a wrap. I think what the person is asking is, it's the pretty pictures, it's my headquarters, it's, whatever.
No. That's totally not important. And actually it's it costs money to do that, obviously, but just having a simple 10K works.
And then question on ESG. I like this. How do you assess ESG in your analysis, in your valuation?
Governance factors, yes. Environmental, more so now than I had in the past, just because it does penalize the multiple, I think, and the same thing for social. Yeah. So simple answer, yes, it's becoming more and more of a factor, and I think it becomes more of a weight in valuation as well, because let's face it, guys like me that have been in the business, years ago, we could give a damn about ESG factors, but now you have more younger people coming in, and that it's important to them, and I think that will show in the valuation of the companies going forward. So.
One comment I might make on that, if you didn't see it, I would look at the Wall Street Journals a few days ago. They had an article about Credit Suisse, which blew up from a governance perspective. I think the CEO was ousted,
right,
and their ESG scores were off the charts high. And so the article was talking about the disconnect between great scores didn't correlate with reality.
All right, just some other things real quickly here. Always try and be as transparent and consistent as possible. It goes without saying. We already talked about a slide deck. That's important with all the metrics, focus metrics. Conference calls. My opinion is that the management narrative on a conference call should be kept to 10 to 15 minutes, hitting the highlights of what you need to talk about with either the CFO or the CEO, or depending on the company, CFO taking the lead. One of my pet peeves is a CFO going through historical numbers and it taking 10 minutes to do it. There's no reason. We can all see those numbers. I think what the CFO needs to do is call out any outliers, hit any highlights. You really want to leave as much time for Q&A on the call. On the conference call itself, I think it's really a good idea to limit each analyst to one question, let them get into a queue for follow-ups. We have had situations where some of the major analysts on the street have monopolized and take the first 10 or 15 minutes of the Q&A, and I think that's really wrong. Some other things is, these are little nitpicking, limiting the number of analysts that cover your company. I just think that you have too many mouths to feed when you start having 20 plus analysts out there. But again, that's just my opinion, especially with some of the smaller names. With analysts, be upfront with them if they're going to pick up coverage as what they can expect with C-suite access, NDRs with institutional accounts, and conference attendance. I think that's important. And then problem analysts, which there are problem analysts out there, numbers too high, bombastic assumptions, either positive or negative. I would just say, do not hesitate to terminate an analyst that is not representing your company realistically, because it doesn't help anybody.
Yeah. Hey, Gary, there's a question in the chat box. I don't know if this impacts you. What market strategists have the greatest influence on your analytical outlet? I know, the bulge bracket firms, Morgan or Goldman, if they say, hey, market multiples are coming down from X to Y, are you taking your multiples down when, the great gods speak, or?
No, because my multiples on companies are going to be based on what the comparative trading analysis tells me. So if because of what the strategists are doing, the multiples of things are coming down, that will be reflected in the average PE or total enterprise value multiples that I'm basing my company price targets on. But I do listen to these people. I mean, I think Ed Yardeni is really good. There's a guy, I forget these guys' names, but he's been spot on. He works for some firm in Minnesota that it's a independent research arm. I forget his name, but I see so many people. And then I also look at technical analysis. I listen to Katie Stockton. I think she's pretty good, very good. So, but I have to be like a sponge. I have to listen to everybody.
Yeah. Okay. Good. I think we've covered all the questions. Gary, before I close this out, any parting pearls of wisdom as these folks get ready to work on their year-end earnings?
No, I mean, I just think this has been a great discussion. I've given you what my my opinions are, my perceptions, and I would say just try and be as transparent and consistent as possible with the street, and I think everything will take care of itself at that point.
Great.